Hey, what's up YouTube? On this video, I'm going to share with you an update to my M1 Finance portfolio. And I'm going to answer a couple of questions that I've gotten from a couple of people over the last couple of weeks. The first question is, what is the difference between an ETF and a mutual fund? And the second question is, what does it mean when my account balance is in the red? And what should I do? Should I sell or should I buy some more? So stay tuned for those answers and an update to my M1 Finance portfolio. My name is Paris Clough, and this is Financial Self-Reliance. On this channel, we talk about the mindsets and the skill sets of the wealthy so that you can learn how to manage, protect, and grow your assets. If that sounds like the kind of channel and the kind of community you want to be a part of, go ahead and click like and subscribe so that you don't miss any of the videos that I produce. All right, now let's jump right into what's the difference between an ETF and a mutual fund. So let's do a little bit of a history lesson so I can explain what a mutual fund is and how ETFs actually came about. I'm going to share with you the Reader's Digest version. If you want to know more and get into details, there's plenty of information on Google. So basically, mutual funds were started because the average investor didn't have enough money to be properly diversified into the market. Back before mutual funds, in order to be diversified into the market, you had to buy a lot of shares of a lot of different stocks. Not enough people had enough money to buy enough shares in one company, let alone buying enough shares in several companies. And so they came up with mutual funds. One of the ways that I explain mutual funds very simply is, have you ever been at work where everybody said, hey, we're gonna go buy a bunch of lottery tickets, does anybody want in? So you put in a few dollars and everybody puts in a few dollars, and then you all go buy a bunch of lottery tickets with all the money that everybody pooled together, and then whatever you win from those lottery tickets, you split evenly amongst the people that put money into the pool or into the pot. Conceptually speaking, that's how a mutual fund works. So a mutual fund is basically when a bunch of people pool their money together in order to have enough money to buy enough individual stocks from enough individual companies to be properly diversified into a sector or into a part of the market. And so one of the problems with mutual funds is that mutual funds can be very slow. They're kind of slow and steady. What that means is that if you want to get your money out of a mutual fund, you literally have to wait till the end of the business day or the end of the market close to be able to determine what your mutual fund unit is worth. And then once you know that what it's worth, then they sell it. Well, it takes till the next day to sell, and then you finally get your money, and it could be 24 to 48 hours before you get your money. So if the market is crashing or going sideways, you don't want to wait 24 to 48 hours to get your money. You want to be able to get your money right away. If you want to get out of that fund, you want to get out of it right now. And so that's where the demand for speed and more agility in the market created what are called ETFs, or exchange traded funds. An exchange traded fund, in very simple terms, is more like a stock than a fund, even though it represents a fund. It's traded faster and more quickly. It's traded in real time, meaning if you wanted to get in and buy the fund or get out and get your money back, you could do it according to real-time market fluctuations and market timing. So if you wanted to get out right now, you just place the order and you get out. With a mutual fund, you place the order, and a day or two later, you'll get your money or whatever's left of it. So exchange-traded funds were created to be able to have quick agility in the market, to be able to trade quickly like a stock, but have the diversification like a mutual fund. So an ETF is kind of that crossover between a mutual fund and a stock. I hope that helps answer any questions you might have about what's the difference between an ETF and a mutual fund. Before I share with you the answer to the next question, which is basically, what do I do when my account value is in the red? I'd like for you to look in the description below. I have a few links there. One of the links is to a 30-day challenge that I created. It's a free course, and it's going to help you get back on track with your finances. In that challenge, I challenge you over the next 30 days to increase your positive cash flow by as much as possible. And at the end of 30 days, to let me know how much you increased it by. I give you actionable items, things you can actually do to increase your cash flow in that 30-day period. So it's a very valuable course, and I highly recommend it. The other thing is that I've got a survey down there for you to determine your wealth potential. Would you like to be wealthy? This survey will help you understand a few of the characteristics, habits, and traits that will help you know whether or not you have what it takes to become wealthy. Click the links in the description below to take my 30-day challenge and to take the wealth potential survey. All right, now here's the next question. What do I do when my account is in the red? So let's say that you've invested $100 into the market, and today it's only worth $90. That's a 10% loss. You are currently in the red. What do? Do you sell? Do you get out? Do you panic? Or do you realize that this is just a blip or a speed bump on a long road towards retirement? There's an old saying that you should buy low and sell high. So when your account balance is in the red, that means that the market is low. Based on the buy low, sell high mantra, you ought to be putting more money in as your value gets low. Now, you definitely want to make sure that you're in the right things when you're in the market. You don't want to be riding a losing horse. But at the same time, if you continue to put money into the market every month, you're going to end up buying more and more shares and more units as those shares come down in value, because inevitably the market will take a turn and come back. See, in the journey of 1,000 miles, what does a little half-mile blip mean to you? Not much. So if the market is not doing well for a few half miles or a few miles, you know that you've got a long road ahead of you, and as long as you systematically put money into the market, you're going to be absolutely fine. Now, if you need to have the money next year or in the next few months or in the next few years, first of all, you've probably put your money in the wrong place. It should be in an emergency fund where it's guaranteed not to lose anything. But if you're looking at a 10, 15, 20-year horizon for needing that money, and you have a couple of days when your account's in the red, that doesn't matter. You've got a 10, 20, 30-year time horizon, a couple of days in the red is not going to do you any harm. In fact, it's the best time to start buying more so that as that 20, 30-year time horizon comes along and you look at the value 20, 30 years from now, you're going to say, wow, I'm glad I bought more of those shares when they were at a lower price because now they're at a higher price and I have much greater value in my account. So a little bit of red from time to time is no big deal. However, it might be time for you to evaluate to make sure you're in the right things, because if you're in the red for too long, you might be invested in the wrong things and you might be riding a dead horse. All right, now let's take a look at my M1 Finance portfolio. The last time I did a portfolio update, I had just over $5,000 in the account. I've actually put a couple $1,000s more into this since the last video. So I put $7,000 in. And so right now, if you look, I'm at negative $136.98 with a negative 2.58% return. So that means that my $7,000 is now only worth $6,858. So the idea here of what do you do when your account's in the red, I'm living through that question right now myself. So what am I gonna do with my account in the red right now? I'll probably buy some more stocks. I'll probably put more money in here because it's buy low and sell high. So there's a couple things I wanted you to see this really quickly. First I wanted you to see in this particular pie right here, I have 5 slices and they're all ARK slices. Now ARK is getting a lot of buzz in the market right now in the news because Cathie Woods has really done a great job with her investments and her investment strategies. Right now, ARK isn't doing terribly hot, but again, these are blips in the market. We're on a long road here, and these are just a few little speed bumps, a few little blips. No big deal as far as I'm concerned. In fact, this is my opportunity to buy in and buy a little bit more. So one of the things that I wanted to share with you is if you were to click, you would see all the latest news. So if you ever wanted to do any research, you could literally come in here, click on the fund, and then do some research, and you have all the news here and the research here. Another one I wanted to share with you is Tesla, because Tesla seems to be pretty popular with a lot of people. So Tesla is in my stocks portfolio, my growth stocks portfolio, and you can see that's in the red right now, $113. So let's take a look and see. If you look here at Tesla, when I first started buying Tesla, it was $870 or so per share. Right now, the price per share is $670. But over here, you see my average share price is $788.95. What that means is that the last several times that I put money into my portfolio, it was 870, it was 700 and something. It's now 670. So as you can see, many people might say, well, Tesla's going down. Paris, it's time to sell. That's not what you want. You don't want your stocks to go down. Well, if you're buying more, if you're in the accumulation phase of your retirement building, which means you're putting money into the market from your income, from your job, from your business, from what you're earning, if you're earning money and putting it into the market, when the stock prices go down, that's wonderful. In fact, that's what you want. You want the stock prices to go down so that you can take the earned money and put it in there and turn it into portfolio money. And then you can buy the stocks at lower prices because my $100 or my $1,000 buys me more shares now. I'll actually have been buying low, so as the price comes back up, I'll have now ability to sell high if I want to, or the value will be much higher because I bought it and when it was low. So my advice is when the stock prices are going down, get more money into the market. Do it wisely, do your due diligence. Don't just throw money against the wall, but make sure that you're putting money into the market on a regular basis. And if the market's going down, count that as a blessing because you're going to be buying more shares of those stocks and more units of those funds, and you're going to be in a better place when that market comes back, or even if the market comes back to normal, you're going to still be in a better place. So I just wanted to share with you an update to my current M1 Finance portfolio. My M1 Finance portfolio is the portfolio that I'm actually building towards in that financial independence number where I'm going to be able to pull 4% from that and live forever, hopefully. I have a business that pays me a passive income. I'm creating a dividend portfolio on my Webull account, and in this one, I'm creating a large balance that's going to pay me 4% that I'll be able to live on. So hopefully by creating multiple streams of income or multiple opportunities to have passive income, at least one of them will take care of my wife and I for the rest of our lives. Now, honestly, putting money into the market and buying and holding is a slower way to go about it. If you want to really go about it quickly and fast, you have to create a business. create a side hustle. Do something to generate income. The faster you can make more money and put that money to work for you, whether it's reinvesting back into a business or it's investing in stocks or ETFs. ETFs are kind of that set it and forget it. You can put it in there, follow the market, you're gonna be fine. You don't have to be sophisticated. You can just put money in there and go for it. I hope that you got a lot out of this video. I hope that the questions that I answered today were questions that you might have had, or maybe they helped you understand a little bit better what an ETF was, what a mutual fund was, and what you should do when your account is in the red. I hope you have a great day, and I look forward to seeing you on the next video.